All right, let's get going. I did not get a chance to do Blake's Business Minutes this week, so we're jamming them all into a weekend edition. Let's get it going starting now. As always, we've got to start off with U.S. equities that finished mostly higher, with the Dow up 0.3%, the S&P and NASDAQ both finishing up almost 2% on the week, which is good after a few weeks of volatility and a little bit of downside. Some of the winning sectors on the week include energy, utilities, industrial metals, big tech, semis, defense, food, and life insurers all saw rallies this week. Also, some notable laggards as far as industries included home builders, building materials, department stores, staples retailers, not the specific staples as in things you need all the time. Apparel retailers, casual diners, investment banks, credit cards, and biotechs all struggled as well. Narratives around stocks this week were largely missing a major headline, but hawkish Fed policy continues to be a major theme that is causing market movement. With the latest round of Fed speak has the street ratcheting up for more aggressive and front-loaded tightening cycle as calming inflation continues to be a major focus. So that means that the interest rates are rising. The Fed is very much in on reining in inflation, as that's one of the biggest things that the market and just people in general are talking about. So expect that hawkish kind of policy making to continue forward and continue to move the markets. Now let's get into some of our biggest stories, some of the things you would have seen Blake's Business Minutes on. Starting with Koch Industries. Company known for its vicious defensive interest in oil is betting big on the U.S. battery space, as the energy conglomerate that is one of the largest privately held companies in the world has made 10 investments worth at least $750 million in the battery supply chain and electric vehicle space over the last 18 months, which is crazy if you know anything about Koch Industries. Additionally, analysts have noted that these investments have made Koch one of the largest diversified battery investors in the U.S. And Koch is now the largest shareholder in some major names in the space, such as Freyr Battery, Aspen Aerogels, wow, can't talk on this Sunday afternoon, and Standard Lithium. And these strategic investments are providing a much-needed boost for the entire U.S. battery industry at a time when cash is crucial, as a lot of these companies are going from the R&D, proving out their product phase, to commercializing their products and trying to become a profitable company by selling them to people across the kind of different sort of customer bases. And the investments are not coming straight from Koch Industries. They're coming from a subsidiary called Koch Strategic Platforms, a newly formed subsidiary of Koch Industries that was created in 2020 to invest in energy transition, computing automation, and healthcare, which is particularly notable because Koch is one of the largest owners of oil pipelines, refineries, and a slew of other oil-guzzling industries that post an annual sales of roughly $120 billion a year. So this is pretty much a huge strategic change for Koch, and is an interesting trend to watch out for as major oil and gas producers begin to dip their toes into the new age of energy. You've seen this a lot with some of the oil majors, but Koch has been so far in the defense of oil and gas that it's a completely different ball game that they're now stepping into this space. And in other news, continuing on in the renewable space, Brookfield Properties has announced a 5-year agreement with Brookfield Renewable to supply renewable energy to its One Manhattan West development. The energy will be sourced from hydropower facilities in upstate New York and will meet 100% of the building's energy needs. And this is important because it makes One Manhattan West Brookfield's first 100% electric-only building in its New York portfolio, and its New York portfolio is large for anyone who is familiar with Brookfield out there. So a big step for them, making one of their newest, shiniest buildings all electric. They're also taking a big step forward in technology tracking, using blockchain carbon accounting platform ClearTrace to digitally match the building's electric consumption with energy supplies and associated renewable energy certificates on an hourly basis to make sure that they really are having that 100% match to renewable energy. It's also going to take it even a step further and provide digital dashboards to each tenant so that they can track their own portions of the building's energy consumption, which is huge as ESG initiatives become a major kind of focus point for a lot of big companies out there, which could be potential tenants for One Manhattan West. So important stuff there. A lot of stuff is happening in the renewable space. It's a very interesting time to be in that space. And real estate is really one of those industries that's been pretty far behind, so taking a big step forward. So let's move on to M&A news, as Warren Buffett has broken his takeover drought and has agreed to buy insurance company Allegheny for $11.6 billion, or $848.02 per share, a 16% premium to the 30-day average stock price. And this is Berkshire Hathaway's biggest deal since 2016, making it pretty notable because Warren Buffett has been open about how he doesn't see any deals in the market for a few years now. So pretty interesting that he's jumping back into the game. A little more on Allegheny. It's involved in a slew of different parts of the insurance business, the businesses that Buffett knows well, including wholesale specialty, property casualty, reinsurance, all just to name a few. And to add some intrigue to the deal, Buffett chose the oddball price of $848.02 to show a true disdain for the money shuffling investing bankers, making sure that all investment banking fees would be paid out of the Allegheny shareholders' proceeds, which at the end of the day is going to cost Goldman Sachs, the lead banker on the deal, roughly $27 million in missed fees. Which is fairly interesting. Warren Buffett has another thing he's been on the record saying. He doesn't think that investment bankers provide enough value. He was a big investor in Goldman Sachs for a long time after the financial crisis. So very interesting here that he really chose to stick it to the investment bankers with this price. So Warren Buffett back in a big way in the insurance space. Now, let's get into Web3, something I haven't covered a ton, but we'll be covering much more going forward. And we've got to start with some big news in Web3 as Yuga Labs, the creators of the Bored Ape Yacht Club, possibly the most popular NFT collection out there, 2 weeks ago made a major splash by purchasing the intellectual property rights to trailblazing profile picture NFT collection CryptoPunks and Meebits from Larva Labs. This is, as far as my knowledge, the biggest Web3 M&A deal ever to really take place. And Yuga Labs didn't stop there, as they continue to capture headlines and are by officially becoming a unicorn after their first round of funding, as the Miami-based firm raised $450 million in a round led by A16Z, otherwise known as Andreessen Horowitz, at a $4 billion valuation. Huge news in Web3. Pretty crazy things happening there, and we'll keep you updated with Yuga for sure. In Carl Icahn news, his battle with Southwest Gas continues to amp up as he has pushed his bid to purchase all outstanding common shares of the company up to $82.50, up from his previous bid of $75 a share. And significantly higher than the company's current price, which is trading in the mid-60s. In addition, Icahn is running a full slate proxy contest to replace the entire board of the company. Icahn has had Southwest in his sights since late last year, noting a slew of displeasures, including accusations of management enrichment, massively overpaying for Questar, and general mismanagement that has led to undervaluation in its regulated utilities business compared to peers. I've done a couple business minutes on this one. It's an interesting one. Icahn, he seems to have some solid footing, some solid ground. It'll be interesting to see if the increased share price, increased bid will help them make it happen and get the deal done. Some more in takeover news. The highly publicized $9 billion Elliott Management and Brookfield Asset Management takeover bid for Nielsen was rejected by the company, saying the proposal, quote unquote, significantly undervalues the company and does not adequately compensate shareholders for Nielsen's growth prospects, which investors did not take kindly to that news as shares dropped 8% on Wednesday. Now let's finish up the episode with what we're looking at for next week. A few major earnings releases coming out. On Monday, we have Jefferies Financial, the investment bank. Tuesday, the biggest day with Chewy, Lululemon, McCormick, Micron, and PVH, and Walgreens on Thursday. And that's it for this weekend edition of Blake's Business Minute, Blake's Business Weekend Show, whatever we want to call it. Next week, I'll be back to the daily segments. I might continue to do this in the weekend, though, do a kind of a long-form YouTube show at the end of each week. I don't know. We're figuring things out as we go, as always with Blake's Business Minute. Also, I have to give a shout-out. Marinas and Martinis, my side hustle. I'm going to start doing more content about them. Some side hustle Sundays, per se. We'll figure that out as well. So go check it out, www.marinasandmartinis.com. Any of you who know me, I used to work at Macy's. This is my little side business. So go check it out. Help support the brand. You'll be hearing more about it soon. And that's it for a weekend edition. Hope everyone has a great Sunday evening, Monday morning. Let's get after it this week. Let's have another great week.